Let's bring in our guest for the hour. We've got Stifel chief economist Lindsey Piegza joining us this morning. Lindsey, you know, the market expectation has really shifted over the last several days to a 75 basis point hike. It sounds like you're still holding steady on that 50 basis points. What are you expecting?
I think it's going to be difficult for the Fed to justify a larger increase later this afternoon, given the rhetoric that they've previously shared with the market, suggesting that a 75 basis point increase is not something that they're considering at this point, and 50 basis point increases is what the market should expect for ongoing meetings. So I do think it's going to be very difficult. The Fed has essentially predetermined policy at this point. Now, that's not to say that the Fed chairman can't open up or broaden the potential pathway for policy going forward. During the press conference, he can certainly say that given the unexpected rise in headline inflation, a 75 basis point or larger increase may be appropriate, or maybe something that the committee will be willing to consider. At the same time, we have to remember that the core level of inflation, really the primary metric that the Fed looks at, is beginning to show improvement. So I also think the chairman is going to remind market participants that inflation is showing some signs of abating, at least in some areas, or leveling off in other areas. And of course, this morning's disappointment of retail sales reminds us that the economy and the consumer are still very much under pressure. And given that the vast majority of price pressures are stemming from the supply side, further, more aggressive rate increases may not be the policy answer. So there's a lot that the Fed chairman is going to try to disseminate in terms of the message to the market.
Hey, Lindsey, Brian, Cheung here. So, I guess on that point, what do you expect to see on the messaging from the Fed with regards to the rate path for the remainder of this year? Because either way you cut or slice it, regardless of whether or not you expect 50 or 75 today, all signs seem to be pointing to something more aggressive than was plotted forward in their last economic projections in March.
Oh, I think they're going to remain ambiguous. I think they're going to keep their options open. They're going to say that inflation remains too high and further Fed policy action is warranted, but I think they're going to be a little more careful in terms of quantifying the appropriate pathway, or as they expect the appropriate pathway to evolve. So I don't think that the messaging is going to give us much indication or much clarity as to what to expect going forward, adding not necessarily undue, but certainly additional volatility and uncertainty to the equity and fixed income markets going forward.
Lindsey, let me push back on your earlier point because, certainly you've made the case for a 50 basis point hike. And yet there is the argument on the other side that says it's better to move more aggressively so that ultimately when we start to see the slowdown, you can pull back just a bit. What's the counter argument to that?
Well, the counter argument is if we move too aggressively or too fast, raising rates to a too high level, you undermine growth and force us into recession. Whereas if the Fed took a more balanced approach to raising rates, they may be able to still navigate some sort of softish landing. Again, raising rates only addresses the demand side of the equation, which is already beginning to falter. Excuse me, with the impact of the earlier 75 basis points, income still trending negative, a loss of fiscal stimulus, savings being depleted, we're already seeing the consumer pull back from the marketplace. So the Fed is doing its job in terms of tapping down investment, tapping down consumption. But raising rates does nothing to address the supply side issues, supply side constraints that we're seeing as a result of the aftermath of COVID-19 or international conflict. So by being more aggressive, sure, you have more ammunition in your tool belt to cut rates later when needed, but you're also ensuring a recessionary or worse, stagflationary scenario.
So, Lindsey, do you think that 75 basis points today raises the risk of a hard landing for the Fed?
Absolutely. Absolutely. The economy is still very fragile. And so anytime we're talking about an increasingly more aggressive Fed, that raises the risks of recession, or at least raises the risk of negative growth. It doesn't have to necessarily be a technical recession. But absolutely, if the Fed goes 75 basis points and signals further 75 basis point increases going forward, I think we have to move up our recession call from early 2023 to late 2022.
And finally, Lindsey, how do you think Jay Powell today addresses the issue of inflation coming in from things that aren't necessarily in the Fed's control right now. Russia, Ukraine, obviously still a big question mark. And then there's what's playing out in China and whether, in fact, we could see more shutdowns. How much of that is coming through in the inflation print that we're seeing here? That's not necessarily in the Fed's control.
Well, that's exactly what I mean when I say that's stemming from the supply side, which renders traditional policy metrics less effective in reining in inflation. Again, raising the cost of capital via rate increases can tap down investment, tap down consumption, but it doesn't address any issues in terms of restoring balance to the global marketplace or resolution, which is needed overseas. And so when these issues are raised, I would expect the chairman to acknowledge that these are factors that are certainly contributing to elevated inflation. But I do think he will stop short of specifically articulating that the Fed does not have control over these issues.
Okay, we will all be watching this afternoon. Lindsey, appreciate the time today. Stifel chief economist Lindsey Piegza, along with our very own Brian Cheung. Kind of weatherman, too, right? He gave us a weather forecast.